Are you wondering if FuboTV stock is worth your investment? In this video, we'll break down FuboTV's business model, its growth potential, financial health, and major risks, so you can decide whether it deserves a spot in your long-term portfolio. Let's dive in. FuboTV is a live TV streaming service focused mainly on sports content. Think of it as a digital alternative to cable. It offers live channels including the NFL, NBA, MLB, and more, along with news and entertainment. But unlike Netflix or Disney Plus, FuboTV doesn't focus on on-demand content. It's made for sports fans who still want live TV without the traditional cable box. FuboTV makes money through two main revenue streams. One is subscriptions and the second is advertising. Subscriptions bring in steady monthly income as users pay for access to live TV. Advertising revenue comes from commercials shown during live sports events and other content. The company has also tested premium tiers to increase something called ARPU, or average revenue per user. FuboTV targets a specific group of people: cord cutters and sports enthusiasts. These are viewers who are ditching cable but still crave live sports, and that's a powerful niche. Why? Because sports fans are highly engaged and far less likely to cancel their subscriptions. Let's talk financials without diving into any one quarter. Over the years, FuboTV has shown strong revenue growth, but it still struggles with profitability. Costs are high, sports licensing, tech development, and marketing all add up. And while revenue is rising, free cash flow remains negative. That said, it's common for growth stage tech companies. So what gives FuboTV an edge? It's their sports first strategy. While YouTube TV or Hulu offer a mix of everything, Fubo's laser focused on live sports. They're also exploring interactive features like live betting and predictive stats, which could keep users engaged longer and spending more. Fubo's leadership has bold ambitions at their goal to become the leading live sports streaming platform, not just in the US but globally. They've explored international markets and even hinted at integrating things like AI-driven content creation and fantasy gaming. Now, how do you value a company that isn't profitable yet? You skip PE ratios and look at other metrics like price to sales ratio, subscriber growth, RPU, and churn rate. If growth continues and those numbers improve, Fubo could be undervalued. But of course, there are real risks. First, content costs. Sports rights are expensive. Second, user churn. If subscribers leave after just a few months, revenue becomes unstable. Third, fierce competition. Tech giants like Amazon and YouTube are moving into live sports. And lastly, the lack of profitability means Fubo may need to raise more capital, which could dilute shareholders. Let's look at the bull and bear cases. Bull case: if Fubo becomes the go-to place for live sports, if ad revenue scales, and if interactive features drive engagement, it could be a multi-bagger in the making. Bear case: but if subscriber growth stalls or content costs rise too quickly, or if bigger players dominate the space, Fubo may never become profitable. So is FuboTV a good investment? That depends on your risk appetite. This isn't a safe blue chip stock. It's a high risk, high reward play. If you believe in the future of streaming sports and trust in Fubo's execution, it may be worth keeping on your radar. What do you think? Can FuboTV become the Netflix of sports, or will it get crushed by the competition? Let me know in the comments. Don't forget to like the video, subscribe, and check out my playlist on other US stock deep dives. Thanks for watching.